Good morning, Beverly Hills. How are you all doing this morning? Good. My name is Blair Smith, and I'm a senior director in the Center for Financial Markets with the Milken Institute. And I have the privilege of opening up our session this morning, the future of asset classes. So a lot of the conversation that I lead with the Milken Institute focuses on inclusive capitalism. And probably one of the questions that I get the most is, what is inclusive capitalism? So I wanted to start by saying that inclusive capitalism creates long-term value that benefits all stakeholders, including businesses, investors, employees, customers, governments, communities. And it produces equitable, measurable, and sustainable growth that empowers others while addressing many of society's needs. And it enables stakeholders to participate in the capital markets to support both the end beneficiary as well as the bottom line. So we're very fortunate this morning that we have a select group of very successful stakeholders who will talk about the future of asset classes. Investors are evaluating how traditional tools and portfolios may be evolving and identifying new opportunities to provide risk-adjusted returns while grappling with other challenges like creating a more inclusive investment team and other impact investment solutions. This panel will examine how the gains of the previous market cycles may not have been fully shared equally, as in years past, and how the tide of rising markets failed to lift all alternative managers' boats. But there is a bright side, because the stakeholders on the stage today will talk about the ways that we can help all boats rise. I wanted to introduce my friend and our moderator for the session, Romain Bostic. He is the co-anchor of Bloomberg Markets The Close, the flagship afternoon program for Bloomberg's U.S. television lineup. Prior to joining Bloomberg Television, Bostic helped lead cross-asset financial market coverage across all Bloomberg News platforms. He is a very busy person, and so he will be leaving the stage a few minutes early because he has to be on the air. But we're privileged to have him now. So without further ado, I present to you the future of asset classes.
Thank you, Blair. That was great. And welcome to all of our panelists here, David, Charisse, Edwin, Kim, and John. Let's get right to it. We talk about the future of asset classes. And I think some of you are probably old enough to remember when there were probably only like 4 or 5 asset classes. And as you know, a lot's changed over the last few years when we talk about the diversification as well as the proliferation of some of those asset classes. And I do want to start there, and I'll start with you, Edwin, since you're basically sitting in the middle there, about I guess that proliferation and the diversification that it offers.
One, nice to be with everybody. Thanks for the first question. It's interesting. Maybe I'll try and reflect on some of the things our clients just told us, Romain. At the start of the year, just given all the tumult we faced last year, all the uncertainty, whether it came from an energy crisis, a rate environment that's fundamentally changed, inflation that has been well above what people expected and persistent. It was never transitory. I think it gave many of our clients pause, and maybe this leads into the question on asset classes. We interviewed 200 of our clients in January of this year. That represented over 15 trillion of investable assets, those 200, across 22 countries. And to me, I run the alternatives business at BlackRock. The thing that struck me around the response of all of the respondents, and it was quite uniform what they said, is that yes, the world has fundamentally changed, but as they're thinking about alternatives as an asset class, as an example, they're now looking at it primarily as a provider of income, as a provider of yield. Now,
What are they looking to it as then?
well, interestingly, if you roll back 20, 30 years ago, I think the concept around alternatives was very much about capital appreciation. And so as you think about, and this goes back to what asset classes today play what role in the portfolio, and I think the top thing in their mind today was not necessarily capital appreciation. That hasn't gone. But the need for income, the need for yield. That's the second thing that came up was resilience. And so understanding after the first half of last year when equity markets sold off, 26%, your fixed income portfolio was down double digits, you started to see behaviors and asset classes that we've never seen before. And so the notion of resilience and diversification came really under question. And so to me, just sharing that 15 trillion of investable capital is looking for more resilience today, is absolutely looking for yield and income, but they're seeing these asset classes as we've defined them in the past playing a very different role in the future than they have in the past.
Oh, Sharice, I am curious though. I mean, just because you have more asset classes doesn't by default necessarily mean it's a more diversified pool of options.
No, that's exactly right. And I think the behaviors, when historically you picked fixed income and equities and you pair them together, you expected an outcome where resilience was provided. Proved not to be the case. And so I think hence the introduction of some of these new asset classes, private credit, infrastructure equity. You think about some of these investments that now throw off a yield, but actually in many cases have no correlation to the traditional equity market. And so I think it's raised a tremendous amount of questions, Romain, with regard to what the future holds.
Sharice, I want to get your thoughts on that as well.
Yeah, no, thank you for that. Again, thank you for having me, and so nice to be here with all of you. And I couldn't resonate more with what you've said, because we're seeing it probably in a much more micro environment in our firm. So I run a firm, Harborview Equity Partners. We're a private equity and asset management firm focused specifically on the entertainment and media sectors. Our first strategy was a private credit strategy or opportunistic credit strategy focused on acquiring cash yielding assets in the entertainment space, specifically music catalogs. And so what we saw was very resonant even in, especially last year, as you saw disruptions start to happen in the broader market, where people were looking for allocators, were specifically looking for their diversifier, the thing that was truly resilient, that could offer a cash yield, that was designed by people who really understand credit allocation and credit structuring. So we've seen a lot of that. Obviously, we get to invest in things that people consider quote unquote fun, which they are fun. Culture drives the world and drives the universe. We all, as I tell people all the time, have the soundtrack to our lives. But that pervasiveness of music being so part of the human condition is actually what creates the resilience around the asset class. And if structured correctly, thoughtfully acquired in a portfolio construction, we've been able to deliver that kind of yield to our investors.
John, jump in here, because I know that your firm has offered new products, particularly in the ESG space, as well as some other funds, some of them actually geared more towards the retail side. Is that correct?
That is correct, yes. So there's no question that we've been in a zero interest rate environment for so long. And so last year threw everybody with a curveball, and you rarely see equity markets and fixed income markets have such a bad year at once. So people are looking for a different direction, and some of the asset classes obviously performed not as they expected to, and others do a lot more. And like you talked about private credit, that's something that they have some of the longer cycle type products, some of the private products will do better through some of these cycles. And so at Calamos, what we're about to launch an interval fund in the private credit space with our partner Axia, which is one of the largest credit houses for debt. And the entire objective is to be able to, as we spoke earlier about bringing certain asset classes to retail and managers that they weren't able to have in the past. Some of the bite sizes were too big or whatnot. So interval funds, the structure allows us to be able to do that. So you can have access to managers that you wouldn't able to have. You know, you have a strike a daily NAV, which is a great thing about this product, okay? There's, you don't have to be a professional investor in order to buy that. You can buy small pieces as small as 2,500. And also some of the nice parts of the interval fund structure is there's no K1s. So it's, you know, it's on your 1099. So, and there's quarterly liquidity, which is something that I think sometimes retail investors are looking for.
And David, I know that you've also been exposed to this space as well.
We have. You know, if you look at the evolution of private equity, I've, you know, been in the private equity industry around 25 years. It's obviously become a massive industry. There's a significantly larger number of GPs than there were, you know, 15, 20 years ago. So there's, you know, lots of competition. You need to be differentiated, whether it's with your investors, whether it's with the companies that you're trying to acquire, and really explain why you're bringing something that's, you know, different. You've really seen over the last 4 or 5 years an increasing focus on the retail channel as you look at, you know, the exposure that institutional investors have to alts as a general matter. You know, they have historically kind of had the exposure they've wanted, subject to the vagaries of denominator effects and whatnot. But the, you know, the retail channel's been significantly underpenetrated. And as you think about inclusive capitalism, and as you think about, you know, what I'll call the democratization of private equity, you know, historically, to get access to private equity, you had to be a very high net worth individual, a sovereign wealth fund, or be part of a pension plan that participates in the alt space. But if you were, you know, someone that had a 401k, or you know, you were, you know, an accredited investor but not a high net worth investor, it was very hard to access private equity. So I think it's a very healthy thing for the industry that we're going to provide, you know, access, and, you know, through technology solutions, we're reducing the friction costs, making it more easy for folks to access these products at lower levels. And I think one of the things that we have to do as an industry is really provide education to this, you know, kind of new class of investors that really haven't been exposed to private equity, to understand the value of it in their portfolio, but then also to understand the other elements that, you know, while there are vehicles that create liquidity, as we've seen recently, it's not complete liquidity, and people need to understand these things.
Well, let's bridge the gap a little bit between, I guess, the democratization, if you will, of this space, and of course, sort of the original sort of folks that got pitched this, obviously endowments like yours, Kim. Talk about the diversification, if any, that you're getting pitched right now. Are you finding comfort in that?
Yeah, so you know, listening to everyone, I always think that it's reasonable and understandable how firms are evolving. But there was a view that was presented to us originally of what these asset classes were going to provide to us and the role that they were going to play in their portfolio. And as people start to evolve their firms, the role that they play also evolves, and the structure of the industry also changes. So I think a lot of people looked at private assets, particularly because it was so inefficient, and it was an area that that not a lot of people would play in. There wasn't a lot of capital in it. A lot more capital flowed into the area. And then it became an area where there was lots of specialization, and the specialization provided an opportunity for inefficiency and enhanced returns. And as you move more and more towards democratization, I think the institutional capital steps back and says, okay, is this going to provide the return that we were originally thought we were getting? Is it going to provide the diversification? We were willing to pay pay the price of illiquidity in exchange for returns. What happens when it's no longer an illiquid asset class, and people are trying to address these things in different ways? It makes us step back and think to ourselves, okay, so what is the new role this plays in our portfolio? Do we have to look for other places to find the thing that it used to do for us? And I think that it's all a natural occurrence that happens. There were asset classes that were super inefficient at one time. Even the equity markets were super inefficient at one time, and now it's an incredibly efficient market. I think there is an argument to be made that private equity is going in the same way, and I think that that's going to mean that you do get LPs looking for it to play different roles. I think you are increasingly hearing that LPs are asking about yield and they're asking about things like that because they don't see what some of the other things that it used to provide. And I think so, and I also think that in this environment where we are increasingly, there's increasing uncertainty around these asset classes and the diversification that these asset classes present. So at one time you thought like you had a bond portfolio because it would be a diversifier against equities. It didn't happen last year. And so now people are saying, okay, what can I rely on? Okay, yield strategies, where I know we're gonna actually get a yield. I don't think that's because everybody believes that they want yield strategies. I just think that that's the thing. I can rely on that right now while I think about how I can reconstruct the rest of my portfolio, especially in an environment that there is going to be illiquidity demands on us, because a lot of the foundations and endowments have a denominator effect as a result of the fact that there was so much focused on the private space. So I think all of these are natural reactions to the changes that have been made in the industry, and then it's going to be wait and see. Like, what is the promise that was made, and which part of that promise is kept, and how the relationship has evolved. So I think it's going to be interesting.
And as that industry evolves, so it's now looking past, sort of as David was getting to, the idea past the big endowments, past those big institutional players, and kind of going down the line a bit. And we've seen, to a certain extent, the consequence of that. Once markets sort of took a downturn, you saw some products, folks trying to redeem, some folks maybe not quite understanding lockups and other things like that. How do you deal with that new breed of clients who maybe doesn't quite understand the longer term nature of some of these investments? Sure, anyone. Yeah. Edwin?
So it's hard. Right? I think we're in a different investing regime. I think what Kim said right. Like, at a time when there's such great uncertainty, look to where you can have some certainty and assets that can throw off yield and income. You have liabilities in many cases you need to cover. But as I look at the 3.6 trillion in dry powder in alternatives today, we've had and we've enjoyed, since the global financial crisis, extraordinarily low rates. A fiscal stimulus we've never witnessed before after and during the pandemic. And so we were flush with liquidity. I'm not saying it was not hard it was easy to make money, but actually when all tides rise, those boats do too. And that's just fundamentally changed. I do think the role of that 3.6 in dry powder is going to be an important one. It's going to provide liquidity into those middle-sized companies and businesses that we think have a future. And I think this is why I look at, private lending, middle market lending, with the role of regulation now changing, the banking sector within the US having for years retreated in a way that's removed liquidity from the system. You have sentiment that's getting worse. You have a banking crisis now that's bringing another shock to that system. You've had all that stimulus which has stopped during the pandemic. Actually, the capital markets, the asset managers becoming the lender of choice in many respects.
But how much risk-taking are they willing to take, though, right now? You talk about that dry powder. There's a reason why there's so much dry powder, because a lot of folks have kind of stayed on the sidelines right now.
Yeah, and listen, I think that'll be foolish, because right now you're definitely seeing a repricing. So we look at even private equity, venture and growth equity. You've seen a significant repricing already, Romain. On the large side, you really haven't. So I think if you pick apart each one of the asset classes, there's a role in the portfolio. But maybe if I go back to some of the newer asset classes like private credit and infrastructure equity, just to give you an example, the vast majority of our clients have 0 to a small percent purposefully invested in infrastructure equity. Yet you're seeing trillions of dollars of a shortfall every single year to let our economies thrive and support industry in a way that it should. Even if you take the theme that's decarbonization, this pursuit to a net zero future, of course, according to most estimates, $125 trillion worth of investment is required. If that's the case, as a capitalist, and you think about where we are today, it's an asset class that behaves differently than equities and bonds. You have a shorter supply of capital than you have actual projects that need capital, so there's an imbalance. to me as an investor, that's a good thing. I think there's a multi-year period
Yeah.
where our clients can benefit in an asset class like that.
But David, on the point of that dry powder and sort of what gets that sort of dry powder deployed here, is the concern right now about lack of opportunity? Is the concern about price discovery of new investments? What?
Yeah, I mean, I think there's two or three dynamics that are shaping the market right now. Part of it is the market we were just in, right? So, we're focused on the enterprise software space. You saw a period from, 16, 17 through 21, in part exacerbated by the pandemic, where there was a real, kind of run up in valuations in our space. And, we tried to be very disciplined during that time period. Our deployment slowed down. There were a number of transactions that we looked at that we just couldn't make the math work and underwrite to our returns. And so we tried to remain very disciplined and underwrite to our value creation. That market completely changed, right? So in 21, we were not buying public companies. We were selling, right? We took 6 companies public. We were kind of taking advantage of the market that we were in, and we were really pivoting towards private transactions. As we look at today's market, there's a slow reset happening in private valuations. Obviously, the public reset happened very rapidly. Our most recent transactions with our largest fund were all take privates of public companies, because we could buy what we think are great companies at much more attractive valuations than existed 18 months ago. We're not as active in the private side because you just look at it and say, why am I paying a premium for a private asset right now? And I think there's going to take a couple of more quarters, for private sellers to kind of accept the world as it is. You're starting to, what we always worry about is you don't want to pay an A price for a B asset. And in 20 and 21, there was a lot of that going on in the private markets. And I think now, B and C assets, we don't tend to buy C assets, but B assets are kind of starting to trade for B prices. And, we'll see how that affects the A assets. So we're not, we kind of play the market that we're in. We don't worry about the market. We kind of see it for what it is and decide how we can implement our strategy in that market. The other dynamic is just the cost of capital, right? Capital is expensive right now. So as you're thinking about what investments you're going to make in a company, you've got to do it in the context of the interest rates that you're going to incur and the interest that you're going to spend. You're going to give to Jamie Dimon rather than to your salespeople or customers. So you've obviously got to factor all that into what you can do with the company.
I am curious, Sharice, I mean, given the economic cycle, and usually the idea here that, firms like yours sometimes find opportunities in these down cycles, at least you find more favorable pricing here. Are you using those sort of, I guess, macro headwinds for some of those companies to your advantage right now?
Yeah, I mean, I think absolutely. The same thing is true in our markets when you look at kind of 20 and 21 with rates being so low and there being a lot of dry powder looking for and chasing differentiated returns, even if they weren't resident experts specifically in our segments of the market, that, to your point, David, drove up prices. And so you saw a lot of a similar dynamic in the marketplace that we operate in every day. I'd say, again, because we have sort of a strategy that we think holds over a long duration period of time around the resilience of and the non-correlation of the asset classes and the industries that we pursue, we are seeing, better quality assets at the right prices or value that we think we can continue to pursue. So we continue to see even better opportunities in our deployment today than we saw sort of even 18 months ago. And so we continue to be excited about that relative to the broader market. Obviously, the cost of capital has gone up for everyone, so that also changes the way that we look at the opportunity sets.
Yeah. Well, on that point of cost of capital, and this is for everyone here, is there anyone on this panel that actually anticipates any significant drop in that cost, i.e. interest rates coming down in any sort of meaningful way soon? No one?
Not soon. I anticipate it someday.
someday, but no one's sort of thinking that we're going to sort of harken back to that sort of, basically 0% interest rate environment that a lot of people have gotten comfortable
Yeah, I
with.
think we're gone from the days of free money, right?
Yeah.
But
So how do you adjust then?
I think that we are not the age that thinks we're going back to zero, right? If you ask some of our analysts
Yeah.
who've only experienced zero, they just think this is the blip.
Yeah.
And I think the people on the stage have been through cycles before, and we know that that what we went through of zero interest rates was the anomaly, as opposed to this being an anomaly. So I think we're returning back to exactly how do you construct portfolios, how do you think about what things you can invest in and what you can expect from them with this interest rate in mind. And I think people are just going to adjust back down to that.
I think if we back up and we look at where are people going to get money, where are corporations going to get money, and how are they going to access money now that we're not in a zero interest rate environment. If you look at, it's ironic that we're at the Milken Conference, and if you think about back in the 80s, Michael started a new asset class, high yield, junk bonds, of which I was part of that. That's where I started in the business, and that spurred a lot of financing in the whole world where they weren't able to get financing. I think we're in a similar situation, and if you look at the course of what's happened since there, over-regulations in the big global banks also, like you mentioned, decreased liquidity a lot. I had run a global bank. Dodd-Frank did not help. We had, took down the liquidity. So where did people go for capital? Mid-sized banks. Smaller banks, local banks. Well, we know what's happening to those today. So I think private credit, private equity is going to be a huge proponent of what's going to, people are going to find access to capital going forward.
I do want to start to squeeze in a few audience questions that have come in, and this is for anyone here. And maybe we'll start off here with the return expectation in the private credit, private equity space. The question is that yields on private credit are much higher. Why is the hurdle rate for private credit funds still 7%?
Go ahead, John.
Well, I'm not going to profess to be the expert in private credit, more of the macro approach, but I'll leave it up to the people that...
It's different, right? Listen, we run from middle market lending all the way through to distressed. So between opportunistic, special situations, each fund varies. So that's probably a blended number as the hurdle, Romain. But I do think, importantly, what's happening, the themes you're hearing about more. We talked about asset classes in the past. You're hearing more about themes today.
Right.
Theme of income, theme of resilience and diversification, theme of decarbonization,
Right.
theme of demographic changes, which leads into investments, whether it's senior housing, and healthcare, because we're an aging population.
But to that point, though, I mean, the themes are important, but returns too. And I think to the person's point, I'm not exactly sure if the 7% is aggregated, but the idea that, we've come off 5% on the Fed funds rate. So the idea is that whatever your hurdle rate would have been at when we were at 1% has to be a lot different at 5%. And I know, at least anecdotally, we haven't necessarily quite seen that.
Oh, we're definitely, so returns, I think they're still there, and it depends on where you search. I'll give you an example. So, and I mentioned infrastructure earlier, I can give you a private credit example too. We just invested in a company called Navigator's CO2. Navigator's CO2 is a carbon capture business, going across 5 states in the middle of the country. This is going to take 15 million tons of carbon per year out of the system. The whole industrial belt has already signed up to provide that carbon. The IRA happened, the Inflation Reduction Act. We had underwritten that investment, as an example, pre the stimulus the government is providing to an infrastructure asset class to about 15%. The IRA provides tax credits, loans, and grants. If you think about that stimulus, as banks have stepped back and other things have happened, liquidity was provided. There's a 30% tax advantage now to that type of investment.
Okay.
That went from a 15% IRR to a 19 overnight. So to me, again, this is a difficult environment we're all having to navigate. There are so many more asset classes today than ever existed before. You just need to be very careful where you deploy that capital and what time horizon, there's still meaningful returns to be made, but the risks are higher.
Before we move on, just a quick follow-up from another viewer from the same topic, asking about the history of PE actually making money in a higher rate environment. Kim, I know you talk about the idea that you have a whole generation of managers out there, or at least junior managers out there, that have never really seen this type of environment.
Yeah, so, I don't know who asked that question about the hurdle rate, but I would imagine it's an LP, and it's an LP that was around back in the days when the hurdle rates were 8 and 9%, and then the whole argument that was made to us when the hurdle rates were reduced down to 5% was that that we were in a low interest rate environment, and so if the risk-free rate was lower, shouldn't the hurdle be lower? And so everybody, and then the agreement was, I get it, we're trying to measure how much value add to us relative to a risk-free option. And now that the risk-free option is giving us 4%, 5%, shouldn't you have to beat that? And how much should you have to beat it by to count yourself very good at this, right? So I think that's the struggle that LPs are working their way through right now, because again, it goes back to what was promised when we first started investing in an asset class, and what is the expectation now, and how that's evolving. So I would imagine that it stems from that, and it stems from this idea of, okay, so like the pendulum swings in one direction and it never quite swings back, right? Like it sort of gets stuck where it is. And I think that this is the moment where everybody's trying to think about what exactly does fairness look like? What is the right expectations for LPs? What can we rely on from our managers now that the world has changed? And when should we, in our minds, think that's a success, right? Like, what is the rate at which it should feel like it's worth paying?
Well, that dovetails into another question from the audience, Kim, and I'll start with you on this. And this is also about kind of the obligation you have to find that return, and more importantly, that diversification. And this viewer is asking about asset class rotations and whether you can share anything that you've done, I guess, in this particular environment.
Yeah, I think it's one of the things that happen, and again, going back to the question around the future of asset classes, and it happens in every sort of bull market, is that there are investors who did one asset class, who now do that asset class, plus another asset class, plus another asset class, and it becomes lots of tangential things that make sense. So, and we as LPs agree to it. But the hurdles for one is not the hurdles for another. The expectations for one is not the expectations of another. And the skill of one is not the skill for another. And I always think to myself, like, sometimes managers think they're like Bo Jackson and that could do two sports, and really they're Michael Jordan, who should stick to basketball, right? Like, and so, but you want me to give you the same check for Michael Jordan baseball as you did for Michael Jordan basketball, right? And so I think that there's
I hope he's not watching right now. He's very vengeful.
He don't know where I live. No, well, I mean, look, anyway, I'm not going to. I love you, Michael Jordan. Anyway, but, all that to say, I think there was a lot of rotation that was done to us, and our portfolios were very different than the ones that we thought we had. And so now there's a moment of stepping back and thinking to ourselves, how do we unwind some of that, right? Because there's a lot of unintended bets in our portfolio as a result of decisions that were made not by us.
Right.
And so I think and we're also at a moment where everything looks attractive and unattractive at the same time, right? Because a lot of people say this is the best time ever for privates, and I agree. But the equity markets are also down so much. That's also really attractive. And so I think that, for us, we're stepping back and thinking, what was wrong with our portfolio? What tilts did we have that we didn't intend to have? Which types of investments do we see as being great in the environment that we have before us? And how do we rotate into those asset classes?
Yeah, I also think, we're obviously a GP that, manages a multitude of products and have, had significant growth over the last decade. I think as a GP, you, number one, really need to hone in on why do you exist? What is your point of differentiation? Why should you win, so to speak? And as you're adding new products, is it consistent with that? Are you leveraging something within your ecosystem that is going to be valuable and differentiated, or are you not? And I think if you're just, getting products to get products to accumulate assets, I think you run into Kim's problem of, okay, you're Michael Jordan, not Bo Jackson. And I think you've got to decide, why do you exist, and is your expansion consistent with why you exist or not? And I think there's obviously a lot of alts firms have, we're not the only ones that have grown rapidly, and I think, you have to look at each one and say, okay, are they, like, we're not out there trying to convince other things look like software. We're like, software looks like software, and that's what we're going to do. And that's, I think it's a challenge for every GP to say, okay, I want to grow, there's opportunities to grow, it's healthy for my organization to grow, but am I doing it in a responsible and disciplined fashion?
I just want to stay on private equity for 1 second and talk a little bit about the exit plans, or rather lack thereof, in this environment for a lot of these companies. A lot of investors, of course, are in this. It's not just, of course, what that private valuation is, but maybe the promise of M&A, the promise of maybe entering the public sphere. And I'm wondering how much that's changed, given that we've seen basically any sort of major deals, at least in the U.S., pretty much be choked off.
Yeah, I mean, I'm probably not the best one for this question, because we've actually been able to sell some stuff in the last 12 months.
What was the reception like, though? Was it a slog to do that?
So again, we've sold a number of, I think we've generated 9 or 10 billion of liquidity at returns that are very similar to our historical returns. So we're in a space that for a lot of folks is quite strategic. And so we've been able to maybe in some respects overcome the valuation headwinds and get to exits that we were happy with. But for example, we announced a recent transaction where we had to provide some seller financing to another, very well-known GP who you'd think, why do they need Vista's money? But it helped enable the deal, and was attractive for both of us. And so I think there's some creativity that needs to happen. But I would say, fundamentally, one of the benefits of private equity is that it should be patient, thoughtful capital. Mm-hmm. If you're not in the right market that your business you think is being valued correctly, you should hold, right? And if you're running your business as well, which that's what we're all here to do, you should have the patience to do that.
John, but when we talk about patient capital, particularly when we talk about democratizing access to some of these vehicles with a different type of investor class that maybe isn't used to that, how do you do that? How do you sell that?
I think it's probably a good segue to go into what's one of the largest growing asset classes, which is ESG. I hate the fact that it's been really politicized here in the United States because it is a huge growing asset class. If you look at it just over the last several years, I think in the end of 2022, there was over $40 trillion in that asset class. Bloomberg is actually predicting it to be 53 trillion by 2025, which is they anticipate the entire investable AUM in investments is about 140. So it's over a third of all investments will be in some sort of ESG, and it's very, we have to look at that. The world is going that way. But let me be clear, I'm not in favor of anybody mandating what people should be investing in.
Yeah.
And it's very important that people continue, we have fiduciary responsibilities for performance and returns. And so when we got into the business, I looked and I acquired a team that has been doing this for 25 years. And they, one of the first teams that actually did a fossil-free fund. And they've outperformed, whether it be the MSCI or the S&P, almost every year, being able to invest in ESG. So to me, they said, okay, if I can perform and get returns from our clients and still have a sustainable product, this is a great idea. So what we did is, at the time we acquired this team, I also became friends with not Michael Jordan, but Giannis Antetokounmpo, who's another superstar in the NBA, and we formed a 50-50 joint venture, and we found that we had a lot of shared values, families, community, financial literacy, sustainability, and so we created a fund using the managers that I just acquired.
Yeah.
And we're doing, we just launched an ETF. We're in the middle of launching a UCITS, it's not done yet, but we will, and a regular, open-end fund for access to everybody. And that's what the ETF is. You can buy a share for $25, so maybe one of,
Yeah.
Giannis's fans can do that. So we think it's important to have access. And then we also have a charitable component. We give 10% of the JV's profits back to society.
All right, we only have a few minutes left, so I want to bang through a few audience questions because a lot have actually come in. Let's see here. I'll give this one to you, Sharice. Anyone can answer this. Crypto, is it still an asset class?
Crypto, I don't know. I'm not here to speak on, crypto or other types of digital asset classes. I do believe, though, and I'm sure many of us on this panel believe that there is efficiencies to continue to be had in overall the financial market. So we'll continue to watch blockchain, we'll continue to watch platforms like that as it creates more efficiencies across all financial assets, candidly. But it needs to have, and I think what we've seen in the crypto winter of it all, is that regulation's important. And I know that's probably antithetical to all those who love Web3 and the decentralized nature of it. But having regulation around how we think about these digital asset classes, I think will really help to breed confidence in the institutional market, breed confidence on both the buyer and seller side so that people know what they are not getting.
Yeah.
You've seen things like digital assets they first come to, the entertainment and media markets. It's almost like a test ground, right? There was a fake Drake song last week with AI, right? And so these things first come and test their validity and their efficacy in markets that have IP attached to it. But what you'll see always is that it's hard to live in fear about any of these things, but certainly that you'll see that these opportunities should create more opportunities over time if they're well implemented, if they have an infrastructure of regulation around them that I believe is pretty important, and that we embrace and think about technology as a way that we think about improving efficiencies across all of these asset classes.
Kim, have you made any allocations in that space?
Yeah, we've dipped our toe into it. I think that one of the things that the foundation and endowment community has had the luxury of doing is testing out new types of asset classes, new types of strategies in small ways, and doing a lot of research around it, and then growing that exposure as the asset class becomes more developed, generally wanting to see a pathway for it to grow, for it to be a sustainable thing. I think that one of the struggles that we're having right now, obviously, is when you look forward at what the opportunity set is going forward and what things we should be investing in, a lot of these things seem like they could be really interesting, right? Like you think to yourself, okay, what should be successful over the next 10 years? And some of that's kind of come from managers who are doing something totally new and really creative, and we would want to invest in that. And some of it comes from some of our established managers who really understand markets really well and are going to find really niches into it. But with both of those two constituencies, you struggle with different things, right? For the new managers, you're struggling with the fact that this is a very tricky environment. Do you have the infrastructure that allows you to be successful in this very tricky environment? Do you have the reliability of capital to continue to have a stable business? And so that's why there's a little pause there. And with our established managers, you sit around and think about, like, how much legacy stuff do you have in that's dragging down your ability to actually access these markets? And so, each constituency has issues, but you see how they can benefit in the market that's going forward, and everybody's just trying to see who's going to be able to do it. And so crypto is one of those markets that we went into just small amounts, let's just see how this works. It was way too volatile to be a big part of an institutional portfolio. It's definitely a retail product right now, and so when crypto started to be a problem, I knew it wasn't going to hurt the institutional community. Nobody had it in their portfolios big enough for it to cause a big problem. And so nobody also overreacted to it either, right? It was just kind of like, okay, let's just see where this goes. But we'll see. And I think, much like Cherie says, everybody is thinking that even if crypto is not the thing, sort of the blockchain could be the thing, because you see all these other opportunities. So I think we're going to continue to follow it, and I suspect many of my peers are as well.
Edwin, what is the next big thing? I mean, what's the opportunity now out there?
I think it's something similar to what was just said here with regard to, I think it's as transition capital. Every corner of the world is transitioning, every sector, every industry. And there's an extraordinary appetite and demand to see this change happen. And what does it mean? We did something with Temasek, as you've probably read, albeit a year ago, to take advantage of the transition. And transition is not just renewable power, wind and solar, but it's also, if you take the automobile industry, and I love this as an example, like kids, we have one EV in the house, and they're always prodding, why don't we have another? I'm like, well, until it goes about 500 miles, then, and there's charging stations around other places, then we'll do another. But that's what it is. I mean, it's from the battery storage, an investment when we made with Group 14 allows Porsche now to take their Taycan to much higher miles. Ionity in Europe, so you can now travel from hopefully Norway to the south of Portugal with charging stations all the way around, an open network. To Microworks, a business we invested in that basically creates an alternative leather that's going to be in cars. Now Hermes and Chanel buy it. But if you take any industry, I think to me, Romain, when you look at trying to be a capitalist and how do we help our clients generate a meaningful return so they can retire with dignity, or whatever the end goal is, that transition that we're seeing across all industry is real, it's investable, it's in private equity, it's in private credit, it's an infrastructure, and there's so many things we can touch. And I think we're spending a lot of time helping our clients focus on that. And it's a theme, but it's an important theme there's a lot of investment opportunity.
David, maybe you can speak to the theme of what's going on with software, fintech, and that world right now, particularly when it comes to, I guess, the disparity in valuations between what we're seeing in the private market versus with some of the public companies.
Thanks. I mean, we continue to think enterprise software is one of the most exciting parts of the global economy. And when you look at some of the most recent technologies, there's obviously been tremendous attention to generative AI in the last 6 months. Before that, other forms of AI, machine learning, blockchain. So I'm not a big fan of crypto, but I think blockchain can have powerful applications within enterprise software. So we're very excited.
Substance within AI right now with what we're hearing? Real substance, investable substance?
So absolutely. We have a number of our companies that are looking at how the technology of generative AI can help them create products for customers, or frankly to help themselves operate more efficiently. Like, there may be a time period sooner than we think where computers are writing software as opposed to humans. For example, it's early days of all of this, but we think these technologies are very exciting. We view them more as opportunities as opposed to threats, and really, one of the benefits of our focus is we today operate 85 portfolio companies, about 100,000 total employees. Our ecosystem has the ability to really ingest and think through, from our smallest companies to our largest companies, how to think about these emerging technologies and what the opportunities are. So, software has been one of the most productive tools, introduced into the global economy over the last 50 years. We don't think that's changing, and we think some of these new technologies are actually creating new opportunities for return for our customers, which then leads to returns for our investors.
And just a real quick final question: has anyone actually incorporated AI into their own business, not as an investment, but in terms of managing your own office?
I mean, we are very focused on using a very data-driven approach as it relates to how we engage in the marketplace. And so as we do that, we're kind of generally improving the technology that we use. And so that's helpful. That, again, this is why we don't want to live in fear around any of these transitory technologies that can really help to improve efficiency.
I would say the same. We have a secondaries business, and that market's growing. Private equity traded about $100 billion last year. They're being able to take the data, dissect it, pull it apart, do our valuations and what we think is the appropriate valuation per company, per portfolio. using the data, the technology, and our AI team on the West Coast has just been, transformative to how we equip the humans who create that fundamental perspective and equip that now with the technological, I think, and data advantage. I think it's a huge part
So a
of
complement to the humans, not a replacement.
Absolutely.
Exactly, a complement.
All right.
We've been using it for several years in all the different generations in terms of, like you guys are, identifying in our research as well, and also our wholesalers in identifying the most optimal clients.
All right, I think we're going to have to leave it there. Great conversation. Our thanks to David, Charisse, Edwin, John, and Kim Liu.
Thank you.